Howdy, y'all. I'm Raymond Dahlman, your humble host, and this is the weekly wrap-up for September 24th, 2021. I hope everyone had a good week. It's been quite lovely here in Colorado. Lots of mild days and chilly nights, so that's always nice. And, definitely an interesting week in the markets. A lot of ups and downs. We'll see where things go. I'll cover a little bit of what I'm looking at on my charts and cover some news items, and we'll go from there. So, all right, well, let's go ahead and I'll share my screen real quick. There we go. All righty. So first, let's take a look at the stock market this week. The Dow Jones looks like it was up a whopping 0.72%. We did have some pretty negative days here, but nice bounce back on Thursday, and today was basically flat. With the Fed announcing on Wednesday that they were going to move forward with their tapering measures, and that the bailouts or the money printing should be stopping here in the near future. I'm actually a little surprised by the by the rally in the stock market, but hey, the other side of that coin is maybe investors feel that their cash instruments and their fixed income instruments just aren't safe right now, and they're pouring money into the stock market because it appears to do nothing but go up. So, all right, let's look at the S&P 500. It looks like it was up about 0.56. NASDAQ it's up about 1.25. The Dow Utilities, it looks like they were down about 1.1, and the Dow Transports, they look pretty decent. Looks like it ended about 1.66 up. So again, like I said, looking at the charts, it is a little strange that the market did rally on what you would think would be negative news, but hey, who am I to say? So what I said, when I said earlier that I'm paying close attention to the charts. Here is the Dow Jones chart right here. Let me drag this down a bit. Make that a little bigger. You can see this trend line right here, which was what it had been bouncing off of as a resistance point, really the last year plus. It did start to break it in July and August, and it looks like that trend has ceased. So, what we're looking at here is, is this some advanced, signal that, we're going to have a downtrend over the next few months? Too early to say. Looking here at, stretch this out, the relative strength indicator, it is, below halfway, but it looks like it is climbing back up. The MACD has gone into the negative, which is a sign to me that, we do need to look at being more cautious with our equity investments. You can see back here in February of 20, we crossed that line. We know it happened shortly after that. Same thing back here in October of 2018. You can see how the market waned a little bit. Once it crossed back over, the market went back up. So, looking at the charts, this is what I'm seeing, whether or not, this is a, foreshadowing of something bigger to occur. I personally, my own personal opinion, I think we're going to go through another market downturn because this was propped up by a lot of federal spending. And I'd be curious to see what, if we hadn't done that, we would probably be coming out of recession right now. But, who knows? All right, let me close that and close that. So let's look at the news right now. So Bitcoin slumped a little bit today. China has basically outlawed the, using Bitcoin for transactions. So I don't know if that's really going to long-term put a dent into the crypto market, but you can see that central banks are not real keen on, the money supply being taken out of their control. But we'll see where it goes long-term. The Dow and S&P 500 extended gains for a third session. We just talked about that. Crude oil prices have continued to climb to an 8-week high, and I'll talk about that in a minute. And U.S. Treasury yields rise to a 3-month high, again, because, people have been, moving from fixed income and cash more into the equity market. My, just guesstimation is that seems to be due to, the U.S. dollar and other currencies aren't very strong right now, and there's a lot of worry for inflation. So the stock market for a lot of folks seems to be a safe haven. I don't know if that's going to be the case, but we'll see where things go. Okay. All right. Well, let's take a look at the jobless numbers for this week. Came in at, for initial jobless claims, came in at 351,000. The forecast was 320. Last week's numbers were 332, revised up to 335. Again, just slightly over the forecast. I'm not going to freak out because 1 week it goes up, or 2 weeks in a row we have slightly higher numbers. It's just kind of the way things are. Continuing jobless claims came in at 2.845 million. The forecast was 2.650. Last week's numbers were revised up from 2.665 up to 2.714, putting it still below the forecast for last week, but higher than the previous week's numbers. Again, it's not, it looks like, while this week's trend looks like it's going up a smidge, it's not too drastic. So I certainly wouldn't freak out about it. All right. Well, let's look at the rig counts. This is the Baker Hughes oil rig count. It's up to 421. Previous, we were at 411. So again, as these rig counts begin to climb from the low where we were at about 172, it looks like at one point, we've more than doubled the rig count. And, as long as that continues to climb, and hopefully we have, a mild fall in the Gulf, so it doesn't put a lot of the refineries offline. We should be, again, continuing to see some stabilization and normalization of gas prices. All right. So looking at the, Brent oil futures, they're up to $78, very close to the last peak, which was at, when was this? August of 2018. We were in a very similar position. Before that, it was as high as, what was that, about 111. This was back in 2014. So again, it's, not nearly as high as it was, 7 years ago, almost as high as it was 3 years ago. So again, I think when more production is pumped out, you should hopefully see some oil prices recede. Again, we've had a lot of inflation over the last year plus, so where it's going to settle at, it's tough to say. I mean, you can look back here from the 90s when crude oil prices were in the 20s, and then we had that big spike in 2004 as we had a bit of an oil crunch. Prices peaked up at what was that, $140 a barrel. So, and then they proceeded to collapse down to around $45. So again, I don't even know if we'll ever get back to a normal economy, but having more production will certainly help stabilize prices, at least in my opinion. All right, I had two articles I wanted to jam through here. The first one centers around inflation. This comes from LouRockwell.com. It's called "Get Ready for Non-Transitory Inflation: 10 Things About to Shoot Up in Price." And this is by Carrie Lutz from the Financial Survival Network. This was published today, the 24th. All righty. Get ready for non-transitory inflation. 10 things about to shoot up in price. Electricity is number one. In 2020, 38% of all natural gas used in the United States went to generating electricity. There are 1,793 gas-powered electrical plants in the U.S., while utilities generally buy most of their natural gas through long-term fixed rate contracts. The low spot price that we experienced since 2019 has led to utilities increasing their gas spot prices and decreasing their long-term contracts, with natural gas recently nearing 5.5 per MMBTUs. Higher electrical costs are baked into the cake. In the past 12 months, natural gas prices have rose over 130%. Assuming a prolonged period of increased gas prices, electricity rates will soon start shooting higher. Number 2, heat. It's about to get way more expensive to heat your home. About half of the homes in the U.S. use natural gas for space heating and hot water. This sector alone was responsible for 15% of natural gas consumption in 2020. For the same reasons above, the decline of long-term fixed price supply contracts, prices are headed much higher. Taxes. Unbeknownst to many people, their largest annual expenditure is taxes. Mine, it comes in around 30+% of the top line revenue. So I can definitely say that the federal government is my biggest bill. Let's see. It's not just direct taxes like income, state, real estate, etc., but it's also indirect taxes levied by federal, state, and local governments upon a myriad of businesses and services that are hidden from the consumer view. A large portion of your utility bill goes to pay state taxes. Your cell phone bill contains a number of federal, state, and local taxes. I can speak to this. I used to work for AT&T Wireless. It was my first job when I got out of the Navy doing customer service. And there's a lot of crap on your cell phone bill. You know, universal connectivity charges, and basically you're paying for all the welfare phones that go out to the poor. So whether or not you agree with it, I don't have a say in the matter. A large portion of tolls and other miscellaneous taxes are also part of the mix. Many of these governmental subdivisions employ expensive union-based labor. As inflation escalates, these employees will get automatic cost of living wage increases. This will increase already staggering pension costs. Therefore, governments across the board will be increasing their already high tax burden, and it will result in higher taxes on everything, even if federal income taxes don't go up. Get ready for major upside surprise. Transportation. Large part of our personal budgets are consumed by getting from point A to point B. The cost of this has risen and will rise higher, with gasoline prices up a whopping 85% in the last 12 months. Let me stop there. If they're counting from the very bottom, that's a very unfair way to look at it. We should look at what gas prices were in, say, January or December of 2019. Or December of 2019, January 2020 to really have a fair comparison. So to say it's up 85%, I would disagree with that. Next one is appliances. There's a chip shortage, as chip shortages continue, raw material costs rise and global labor costs take off. To compensate for the near universal loss of purchasing power, appliance costs will increase greatly. Let me skip down to the next one. Automobiles, both the prices of both new and used vehicles have increased greatly during the past 12 months. Expect this trend to keep going for a long time to come. A large portion of the cost of an automobile is labor and legacy costs. Virtually all auto workers were unionized, and they are currently or will shortly be receiving cost of living adjustments, COLA. Many auto retirees receive COLA as well. For legacy automakers, their cost structure is a straight line higher. All right. And let me skip forward to get to the rest of the article. Automobiles, food shortages, expect food shortages, supply chain disruptions, weather issues to drive food much higher in the months to come. There's a reason that government excludes foods from the consumer price index, and it's not because they're going down. Higher fuel costs as a result will also result in higher food prices, as modern farming techniques are energy intensive, not to mention that virtually all food produced must be shipped to market. Interest rates. For nearly 2 generations, interest rates have fallen to some of their lowest levels in several millennia. That's all about to come to an end. The explosion of debt at every level, government, corporate, and individual, has been well documented. Low rates are always dependent upon Fed policy. However, there's a limit to run away money printing at some point, probably rather than later. The Fed will have to make a decision between the economy and the currency. Precious metals for thousands of years, gold and silver have been real money. It's only since the advent of unlimited fiat currency that they have been forced to take a backseat to paper forms of wealth. Somebody doesn't type very well. Since 1971, when Nixon closed the gold window, the paper wealth orgy has continued unabated. Now it appears that the can has been kicked down the road as far as possible, and the day of reckoning is nearly at hand. Guns and ammo. Since 2008, the demands for guns and ammunition has nearly doubled insatiably as the world has gotten deeper into endless morass of debt and loss of freedom. U.S. sales of these essential self-defense products have catapulted forward. The new inflationary trend will increasingly weaken the ability of the government to protect citizens. As Americans, we've been lulled into a false sense of security that government can actually keep us safe. They can't. Moving ahead, this illustration is rapidly fading. Witness the 2020 widespread urban riots. So, all right. So that's everything there. So I will attach. Oops, I accidentally closed it. I will attach that article for you, and if you want to read it, please do. And the last one I wanted to cover is the Eurozone is going straight down the same stagnating road as Japan. This is written by Daniel LeCale. All right. And it was published on September 18th, last Saturday. Let's begin. The European Central Bank announced a tapering of a repurchase program on September 9th. One would imagine that this is a sensible idea given the recent rise in inflation in the Eurozone to the highest level in a decade and the allegedly strong recovery of the economy. However, there is a big problem. The announcement is not really tapering, but simply adjusting to a lower net supply of bonds from sovereign issuers. In fact, considering the pace announced by the central bank, the ECB will continue to purchase 100% of all net issuance from sovereigns. There are several problems with this strategy. The first one is that the ECB is unwilling to acknowledge that there is no real secondary market demand for Eurozone currencies, sovereign debt at these yields. One would have to think twice or three times the current yield for investors to accept many Eurozone bonds if the ECB does not repurchase them. This is obviously a dangerous bubble. The second problem is that the ECB acknowledges that the monetary policy has gone from being a tool to help implement structural reforms to a tool to avoid them. Even with the strong GDP bounce and the ECB predicts, few governments are willing to reduce their spending and curb deficits in a meaningful way. ECB estimates show that after the massive deficit spending of 2020, Eurozone government spending will rise again by 3.4% in 2021, only to fall modestly by 1.2% in 2022. This means that the Eurozone government spending will consolidate the COVID pandemic increase with little improvement in fiscal position of most countries. Indeed, countries like Spain and Italy have increased their structural deficit. Third problem is that negative interest rates and high liquidity injections combined with elevated government spending have generated no real multiplier effects in the Eurozone. We must remember that the main economies were in stagnation already in the fourth quarter of 2019 before the pandemic and large stimulus plans like the Juncker plan, which mobilized hundreds of billions of euros in investments. The fourth challenge for the ECB is that it acknowledges being trapped in its own policy. It can't stop it. And normalization, because governments and markets would suffer. It cannot keep the current pace because inflation is putting even more pressure on growth. Final challenge for the Eurozone and the ECB is that it continues to implement policies that ignore demographics and structural burdens to growth. The Eurozone has an aging population, and monetary and fiscal policies seem to ignore the evidence of changing consumption patterns when governments reach a certain age or retire. If we add the demographic of a taxation system that increasingly hurts middle classes, businesses, and investment, we face an economy that seems to be following all the wrong policies that Japan implemented at the beginning of the 90s. As Japan did, the Eurozone is betting all on government spending, chains of stimulus packages driven by political directions, and massive debt monetization. However, the Eurozone does not have the disciplined labor force that Japan has, nor the elevated levels of corporate and household savings that allow a country to continue in stagnation for decades. Last paragraph, countries like Italy, Spain, Portugal, and Greece cannot survive stagnation due to elevated levels of unemployment and small size of the business fabric. Therefore, the ECB seems to ignore the risks of perpetuating the perverse incentives to bloat government spending and debt. All messages concerning structural reforms and real growth incentives have disappeared in favor of direct stimulus plans that never deliver. Our duty as economists is to warn of the more than likely scenario of poor recovery, low productivity, and higher debt that the Eurozone faces. Fiscal multipliers have been negative for too long for us to ignore the negative crowding out effect of high government spending and the erosion of competitiveness that faces the economy faces. So again, it looks like a mess. We have, these are the same policies that our own federal government and the Federal Reserve have been implementing over the last few years. I mean, we've had interest rates at or near zero for, going back to the aughts. So at some point, the bubble is just going to pop. And, it's going to be unfortunate. There's going to be a lot of carnage and a lot of people hurt along the way. But, those who are supposed to be, in charge of things, just appear to, don't care. So it's sad. It's unfortunate. This could have been avoided. I know there are some that are panicked and worried about the, Fauci flu that's been going around the last year plus. But, you got to live your life, take care of yourself, and, hope that when things fall apart, smart people are going to be in place to hopefully fix things. But we will see. So, all right. Well, that's everything that I had for today. I'm going to, if anyone needs anything from me over the weekend, feel free to shoot me an email or, leave a voicemail on my office phone. I do check those, anytime a voicemail comes through. So, like I said, if anybody needs anything, just be sure to reach out. Also, please share, subscribe, and have a great weekend. That's all I can really ask is enjoy your life. And I'll talk to everyone on Monday. Bye-bye.